I have lived through every major technology bubble of the past 40 years. I was a young engineer during the personal computer boom of the 1980s. I founded my company during the early internet era of the 1990s at a Denny's restaurant with two co-founders and a vision that seemed crazy to most people at the time. I watched the dot-com bubble inflate and explode from the front row, navigating my company through one of the most brutal market crashes in history. I survived the housing crisis and financial meltdown of 2008, when companies we thought were invincible collapsed overnight. I saw the cryptocurrency mania of 2017 and its aftermath, watching billions of dollars evaporate as quickly as they had appeared. And now I am watching the artificial intelligence boom unfold in real time, with all its promise and all its potential dangers. Through all of these cycles, I have observed something remarkable. The patterns repeat with almost eerie consistency. The specific technologies change, the companies change, the investors change, the terminology changes. But the human behaviors, the market dynamics, the warning signs that precede the bursting of every bubble, these remain constant across decades and across different asset classes. If you know what to look for, you can see the cracks forming before the collapse happens. You can position yourself to survive and even thrive through the transition. Today I want to share with you what always happens before a tech bubble bursts. Not because I believe we are necessarily in a bubble right now, though we might be, but because understanding these patterns is essential for any investor, any entrepreneur, any professional who wants to build durable wealth through technology cycles rather than being destroyed by them. The people who recognize these warning signs can protect themselves and even profit from the inevitable corrections. The people who ignore them become cautionary tales that future generations study and shake their heads at. Let me start it with a story that shaped my understanding of bubbles forever. It was 1999, and I was running a graphics chip company that was growing rapidly. We had survived the early challenges of building a semiconductor company, had found our footing in the gaming market, and were starting to see real traction with our products. The internet boom was in full swing all around us. Companies with no revenue, no products, and sometimes no clear business model were going public at billion-dollar valuations. Engineers were quitting stable jobs at established companies to join startups, offering stock options that seemed certain to make them rich. The NASDAQ was climbing almost vertically, reaching new highs every week, sometimes every day. I remember attending a conference where a venture capitalist gave a presentation arguing that traditional valuation metrics no longer applied. Price-to-earnings ratios were obsolete, he said. In the new economy, what mattered was eyeballs, page views, growth rates. Profits would come later. The important thing was to capture market share before competitors did. The audience nodded along enthusiastically. This seemed to make perfect sense. Within 18 months, that venture capitalist fund had collapsed. Most of the companies he invested in went bankrupt. The NASDAQ fell nearly 80% from its peak. Trillions of dollars in paper wealth evaporated. Engineers who had quit their jobs found themselves unemployed with worthless stock options. The new economy turned out to be subject to the same old rules after all. I survived that crash because I was running a real business with real products that real customers paid real money for. But I learned something invaluable from watching so many others fail. I learned what bubbles look like from the inside. When everyone is convinced that this time is different and the old rules no longer apply. Let me tell you about the first pattern that always appears before a tech bubble bursts. It is the widespread belief that traditional valuation metrics no longer matter. Every bubble develops its own logic, its own framework for justifying prices that would seem insane under normal analysis. And that framework always involves dismissing the metrics that would reveal the insanity in the dot-com bubble. It was the idea that profits did not matter because growth was more important. Companies were valued on revenue multiples, then on growth rates, then on user counts, then on page views. Each shift to a new metric occurred because the previous metric had become embarrassingly stretched. When price-to-earnings ratios reached 100, people started talking about price to revenue. When price to revenue reached 20, people started talking about price to growth. When price to growth became absurd, people started talking about market opportunity and total addressable market. The same pattern appeared in the cryptocurrency bubble. Bitcoin had no earnings, no revenue, no cash flow. It did not produce anything. Traditional valuation frameworks could not be applied because there was nothing to value in the traditional sense. So new frameworks emerged: network value. Metcalfe's law applied to cryptocurrency adoption. Stock-to-flow models borrowed from commodity analysis. Each framework provided a seemingly rigorous justification for prices that were actually just speculation. The pattern is appearing again now in various parts of the technology market. I see companies valued at 50 or 100 times revenue with no clear path to profitability. I hear analysts dismissing concerns about valuation by pointing to growth rates or market opportunity or strategic positioning. I watch investors pay premium prices for businesses that will not generate positive cash flow for years. If ever, this does not mean we are in a bubble. Sometimes high valuations are justified by genuinely exceptional growth and competitive positioning. But when the primary argument for an investment becomes that traditional metrics do not apply, that is a warning sign. History shows that traditional metrics always apply eventually. Companies eventually need to generate profits. Stocks eventually need to be justified by cash flows. The question is whether current prices already reflect realistic future cash flows, or whether they reflect hopes and dreams that may never materialize. The second pattern that always appears before a bubble bursts is the proliferation of low-quality companies and projects that raise capital easily. In healthy markets, investors discriminate between good opportunities and bad ones. Good companies with strong teams and viable business models raise money. Weak companies with inexperienced teams and questionable business models struggle to find funding. In bubbles, this discrimination breaks down. Capital becomes so abundant and so eager to participate in the hot sector that even poor quality opportunities get funded. Investors fear missing out more than they fear losing money. They lower their standards to deploy capital. They convince themselves that weak teams will figure it out, that questionable business models will evolve, that rising tides will lift all boats. I saw this vividly during the dot-com boom. By 1999, venture capitalists were funding companies with laughably thin business plans. The pitch did not need to be compelling. It just needed to involve the internet somehow. Companies raised millions of dollars with nothing more than a website mock-up and a vague vision of how they would eventually make money. Most of these companies failed completely, but in the heat of the bubble, they had no trouble attracting investment. The same pattern appeared in cryptocurrency. By late 2017, initial coin offerings were raising hundreds of millions of dollars for projects with nothing more than a white paper and some social media marketing. Many of these projects were outright frauds run by people with no technical capability and no intention of building anything. Many others were well-intentioned but completely impractical, founded by people who genuinely believed in their vision but had no realistic path to achieving it. It did not matter. Investors were so eager to participate in the cryptocurrency boom that they funded almost anything with blockchain in the description. I remember talking to a friend who invested in an ICO for a project that claimed it would decentralize the fishing industry. The fishing industry, the white paper was filled with jargon but contained no coherent explanation of how blockchain technology would actually improve fishing or why anyone in the fishing industry would adopt it. My friend invested anyway because he had made money on previous ICOs and did not want to miss another opportunity. He lost everything when the project collapsed. When I see capital flowing easily to companies or projects that would never get funded in a normal market, I know that standards have deteriorated. That deterioration is both a symptom of bubble conditions and a contributor to the eventual collapse. All those poorly funded companies eventually fail, and their failures contribute to the loss of confidence that triggers the broader crash. The failures also tie up capital and talent that could have been deployed more productively, creating opportunity costs that persist long after the bubble bursts. The third pattern that always appears before a bubble bursts is the mainstream adoption of speculation by unsophisticated investors. Bubbles start with sophisticated investors who understand the technology and the risks. They make early bets on promising opportunities and earn substantial returns as prices rise. Those returns attract attention. Stories spread about people who made fortunes from early investments, and gradually, speculation spreads from sophisticated investors to the general public. This mainstreaming of speculation is a classic late-stage bubble indicator. When your taxi driver is giving you stock tips, when your neighbor who knows nothing about technology is investing in tech stocks, when your college student child is day trading between classes. The bubble is approaching its peak, not because these people are stupid, but because their participation indicates that the pool of new buyers is nearly exhausted. Markets rise when there are more buyers than sellers. Bubbles grow when an expanding pool of buyers pushes prices higher and higher, but the pool of potential buyers is finite. When speculation spreads to the mainstream, when everyone who might buy has already bought or is already buying, there is no one left to push prices higher. That is when bubbles peak and begin to collapse. I remember the signs of mainstream speculation in the dot-com. Bubble day trading became a cultural phenomenon. People quit their jobs to trade stocks full-time from home, believing they had discovered a path to easy wealth. Books about getting rich from tech stocks became bestsellers. Financial news networks saw their ratings soar as ordinary people tuned in to watch stock prices tick up and down. Investment clubs formed in workplaces and neighborhoods, with groups of friends pooling their money to buy hot stocks. Everyone was in the market. Everyone was making money. Everyone believed it would continue forever. I knew a dentist who closed his practice to become a full-time day trader. He had made more money in 6 months of trading than he had made in years of dentistry, and he concluded that his skills were better suited to the market than to teeth. Within 2 years, he had lost everything and was trying to rebuild his dental practice, starting over in his 50s with nothing. The same thing happened with cryptocurrency. By late 2017, Bitcoin was a topic of conversation at every dinner party, every family gathering, every casual encounter. People who had never owned any investment more complex than a savings account were buying crypto on their phones during their lunch breaks. Celebrities were promoting coins they did not understand to followers who understood even less. Super Bowl commercials were advertising cryptocurrency exchanges to the largest television audience of the year. The mainstream had fully embraced speculation, and that embrace was a sign that the end was near. When I see speculation spreading to people who do not understand what they are buying, who are investing based on stories and social proof rather than analysis, who are buying because prices went up last month, and they assume prices will go up next month, I know the bubble is mature. The end may not be immediate. Bubbles can persist longer than rational observers expect, but the end is approaching. The fourth pattern that always appears before a bubble bursts is the emergence of leverage and complex financial products tied to the hot asset class. Early in a boom, people invest with their own money. They buy stocks or coins or whatever the hot asset is, and they hold them. If prices fall, they lose their own money, but the damage is contained. As the boom matures, leverage enters the picture. People start borrowing money to invest, amplifying their potential gains but also their potential losses. Margin accounts allow stock investors to buy more shares than they could afford with cash. Cryptocurrency exchanges offer leverage trading at ratios of 10 to 1, 20 to 1, or even higher. Real estate investors put down small down payments on properties worth many times their cash investment. Leverage is dangerous because it transforms manageable declines into catastrophic losses. If you buy a stock with cash and it falls 20%, you lose 20% of that investment. It hurts, but you still have 80% of your capital. You can wait for recovery. You can average down if you believe in the investment. If you buy that same stock with 5 to 1 leverage and it falls 20%, you lose 100% of your capital. You are wiped out. You cannot wait for recovery because your position has been liquidated. You may even owe money beyond what you invested if the decline happens fast enough that your broker cannot close your position in time. When many investors are leveraged, even modest price declines trigger forced selling as investors scramble to meet margin calls. That forced selling pushes prices lower, triggering more margin calls at other accounts, creating a cascade that can collapse markets with terrifying speed. I have seen markets fall 10 or 15% in a single day during these cascades. Moves that would normally take months compressed into hours because of leverage, induced forced selling. The 2008 financial crisis was fundamentally a leverage crisis. Banks had leveraged their balance sheets 30 to 1 or more. Homeowners had bought houses with tiny down payments, sometimes with no down payments at all. Hedge funds had leveraged their positions to amplify returns. When housing prices began falling modestly, the leverage transformed modest losses into catastrophic ones. Banks that had seemed solid became insolvent overnight. The entire financial system came within days of complete collapse. Complex financial products add another layer of risk and opacity. In the run up to 2008, Wall Street created increasingly complex derivatives tied to housing prices, collateralized debt obligations that bundled thousands of mortgages, credit default swaps that allowed investors to bet on whether those mortgages would default, synthetic CDOs that created additional exposure to mortgage risk without involving any actual mortgages, CDO scored products that packaged CDOs into new CDOs. Each layer of complexity made the system more fragile and the risks harder to understand, even for the people creating and trading these products. When housing prices began to fall, the complex interconnections between these products caused the damage to spread far beyond the original source. Companies that had never made a mortgage loan, that thought they had no exposure to housing, discovered that they were connected to housing risk through chains of derivatives that nobody fully understood. The complexity that had obscured risk during the boom revealed it catastrophically during the bust. When I see leverage increasing in a hot market, when I see complex financial products proliferating that even their creators do not fully understand, I know that the system is becoming fragile. The same boom that creates those products ensures that many investors are exposed when they unwind. The complexity that obscures risk during good times reveals it all at once during bad times. The fifth pattern that always appears before a bubble bursts is the dismissal of skeptics as people who just do not understand. Every bubble has its skeptics, people who look at the valuations, the speculation, the leverage, the deteriorating quality of investments, and conclude that something is wrong. These skeptics are dismissed, mocked, and sometimes punished by the market for their caution. In the dot-com bubble, skeptics were told they did not understand the new economy. The internet was changing everything. Old metrics and old rules did not apply. People who questioned valuations were dinosaurs who would be left behind by the digital revolution. Warren Buffett famously avoided technology stocks during the boom and was criticized as out of touch. Of course, when the bubble burst, his caution was vindicated. In the housing bubble, skeptics were told they did not understand how housing was different from other assets. Housing prices never fell nationally. People would always need places to live. Mortgages were secured by real property. The complex financial products were designed by brilliant mathematicians and approved by sophisticated regulators. How could they be dangerous? In the cryptocurrency bubble, skeptics were told they did not understand the technology. Bitcoin was revolutionary. It would replace fiat currency. The blockchain would transform every industry. People who questioned cryptocurrency valuations were dismissed as boomers who did not get it. The dismissal of skeptics is both a psychological phenomenon and a warning sign. People who are invested in a bubble financially and emotionally do not want to hear that they might be wrong. Skepticism threatens their self-image as savvy investors. It threatens their paper profits. It threatens the narrative they have constructed to justify their decisions, so they dismiss the skeptics rather than engaging with the substance of their concerns. When I see thoughtful skeptics being dismissed rather than answered, when I see the argument shifting from "this is a good investment to you, just do not understand," I know that the bubble mentality has taken hold. The inability to engage with criticism is a sign that the bull case has become a matter of faith rather than analysis. The sixth pattern that always appears before a bubble bursts is the widespread belief that prices cannot fall significantly because too many powerful interests need them to stay high. I have heard this argument in every bubble. The government will not let housing prices fall because it would hurt too many voters. The Federal Reserve will not let the stock market crash because it would damage the economy. The big institutions are too invested to let cryptocurrency fail. Someone will always step in to prevent disaster. This belief reflects a fundamental misunderstanding of how bubbles work. No institution, no matter how powerful, can indefinitely support prices that are detached from fundamental value. Governments can provide stimulus and support during downturns, but they cannot prevent the recognition of reality. Central banks can influence interest rates and liquidity, but they cannot force people to pay irrational prices for assets. The belief that prices are supported by powerful interests is itself a sign of bubble thinking, a desperate search for reasons why the unsustainable can be sustained. When the dot-com bubble burst, the Federal Reserve cut interest rates aggressively. It did not matter. Stock prices still fell 80% because no amount of rate cuts could justify paying 100 times revenue for companies that would never be profitable. When the housing bubble burst, the government intervened massively with bailouts and stimulus. It cushioned the blow but did not prevent the crash. Housing prices still fell 30% or more in many markets because no intervention could justify the prices that had prevailed at the peak. When I hear people arguing that prices cannot fall because powerful forces will prevent it, I know that the bubble is in its late stages. The belief in institutional support is itself a sign that the fundamental case for current prices has become untenable. People are no longer arguing that prices are justified. They are arguing that unjustified prices will somehow be maintained anyway. The seventh pattern that always appears before a bubble bursts is the proliferation of fraud. Bubbles create the perfect environment for fraudsters. Prices are rising, so scams can deliver the promised returns for a while by using new investor money to pay old investors. Due diligence is lax because investors are eager to deploy capital. Skepticism is low because everyone seems to be making money. The consequences of fraud are delayed because rising prices paper over problems. Every bubble I have lived through has been accompanied by a wave of fraud that is only fully revealed after the crash. The dot-com bust uncovered accounting frauds at major corporations, Enron, WorldCom, Tyco. Companies that had been celebrated as exemplars of the new economy were revealed as criminal enterprises. The housing bust uncovered mortgage fraud at every level, from borrowers lying on applications to lenders fabricating documentation to rating agencies stamping toxic securities. The cryptocurrency boom was particularly fraud, rich exit scams, rug pulls, Ponzi schemes, pump and dump operations, outright theft by exchange operators. The industry was rife with fraud that only became fully apparent when prices crashed, and the tide went out. The collapse of major cryptocurrency exchanges revealed billions of dollars in missing customer funds. I cannot tell you specifically where fraud is hiding in today's market. By definition, successful fraud is hidden until it is exposed. But I can tell you that wherever there is a boom, wherever money is flowing easily, wherever due diligence has become lax, fraud is accumulating. It will be revealed when the bubble bursts, and its revelation will contribute to the loss of confidence that deepens the crash. Now let me address the question that is probably on your mind. Am I saying that we are in a bubble right now? Am I predicting an imminent crash in technology stocks or AI companies or any other specific market? The honest answer is that I do not know. I can tell you that I see some of the warning signs I have described. I see valuations that seem stretched by historical standards. I see some deterioration in the quality of companies attracting investment. I see speculation spreading to less sophisticated investors. I see some leverage building in the system. I see skeptics being dismissed. I see people arguing that powerful interests will prevent any decline. But I also see genuine technological progress. AI is not like the dot-com bubble, where many companies had no viable business model. AI is delivering real value to real customers right now. Companies are using AI to reduce costs, improve products, and create new capabilities. The infrastructure being built for AI will have lasting value regardless of how individual AI companies perform. The presence of a real technological advance does not preclude a bubble. The internet was genuinely revolutionary, but there was still a bubble in internet stocks that caused tremendous damage when it burst. Housing is genuinely valuable, but there was still a bubble in housing prices that caused a global financial crisis. AI may be genuinely transformative, while AI-related investments are simultaneously overvalued. My advice is not to try to time the market or predict exactly when a bubble will burst. If there is one, that is a game that even the most experienced investors usually lose. Instead, my advice is to use these patterns as a framework for managing risk and maintaining discipline. When you see traditional valuation metrics being dismissed, that is a signal to be more cautious, not less. When you see capital flowing to low-quality opportunities, be selective about where you invest. When you see mainstream speculation by unsophisticated investors, consider whether you want to be buying what they are buying. When you see leverage building, understand that it increases risk for everyone. When you hear skeptics being dismissed rather than answered, pay attention to what they are saying. When you hear arguments that prices cannot fall because powerful interests will prevent it, be skeptical of that. Suppose protection. When you see fraud being uncovered, understand that more fraud is probably still hidden. These patterns do not tell you when a bubble will burst. They tell you when to be more careful, when to prioritize quality, when to manage risk, when to maintain discipline, even when others are abandoning it. Let me share how I apply these principles in my own thinking and in running my company. I run a business that has benefited enormously from the AI boom. Our stock price has increased dramatically over the past few years. We are selling more chips than we can manufacture, with demand far exceeding our ability to supply. Our products are at the center of what may be the most important technological transformation since the internet. By any measure, we are in the middle of an extraordinary business success that exceeds anything I could have imagined when I started this company over 30 years ago. But I do not assume this will continue forever. I know that booms end. I have seen too many companies that seemed invincible during good times collapse. When conditions changed, I know that the conditions that created this success can change quickly and unpredictably. I know that competition is intensifying as every major technology company and dozens of startups try to challenge our position. I know that customers who are buying enthusiastically today might become cautious tomorrow if they do not see the returns they expect from their AI investments. I know that valuations that seem justified by extraordinary growth can quickly seem absurd if that growth slows even modestly. So I run my company as if the boom could end at any time. I invest heavily in maintaining our technological lead so that we remain essential even if the market becomes more competitive and prices come under pressure. I build deep relationships with customers so that they stay with us through cycles rather than switching to alternatives when times get tough. I maintain financial strength with a fortress balance sheet so that we can survive any downturn and even take advantage of opportunities that distress creates. I keep our cost structure disciplined so that we can remain profitable, even if revenue declines significantly. I prepare for winter even while enjoying summer, because I know that winter always comes eventually. This is the mindset I would recommend for any investor or entrepreneur operating in technology markets. Enjoy the good times. capture the opportunities that booms create. Build wealth while conditions are favorable. But do not assume the good times will last forever. Do not let success make you complacent. Build resilience into your portfolio, your company, your career. Maintain the discipline that will serve you when conditions change, even when that discipline seems unnecessary during the good times. The specific patterns I have described, the dismissal of valuation metrics, the deterioration of quality, the mainstreaming of speculation, the buildup of leverage, the dismissal of skeptics, the belief in institutional support, the proliferation of fraud. These are the warning signs that have preceded every tech bubble burst in my lifetime. They do not tell you when the crash will come. Timing is impossible to predict with precision, but they tell you when to be prepared for one. They tell you when to increase your margin of safety. They tell you when to be more selective and more skeptical. I have survived multiple technology cycles, not by predicting exactly when bubbles would burst, but by maintaining discipline and resilience through all conditions. I have built real products that deliver real value to real customers who pay real money. I have maintained financial strength that allows my company to survive downturns that destroy competitors. I have prepared for bad times while pursuing opportunities during good times. When the crashes came, and they always came eventually, I was positioned to survive them and emerge stronger on the other side. That it's the approach I recommend to you. Not panic, not prediction, not trying to time the market or catch the exact top of every bubble. That is a game that even the smartest and most experienced investors usually lose. Just discipline, preparation, and the wisdom to recognize that what goes up eventually comes down, that booms eventually become busts, and that the patterns of human behavior in markets have not changed in centuries of recorded history and will not change. Now, just because we have new technologies and new terminology, the technology changes, the terminology changes, the specific companies and assets change, but human nature does not change. Greed does not change. Fear does not change. The desire to get rich quickly does not change. The tendency to rationalize speculation as investment does not change. The patterns that emerge from these unchanging human characteristics repeat across every bubble and every crash study. These patterns, watch for these warning signs. Maintain your discipline when others are abandoning theirs. And remember that the best time to prepare for a crash is before it happens, when everyone still believes it never will. The people who prepare during good times survive bad times. The people who assume good times will last forever are destroyed when they end. I do not know if we are in a bubble right now. I do not know when the next crash will come, but I know that crashes always come eventually. I know that the patterns I have described always appear before they do. And I know that the investors and entrepreneurs who recognize those patterns and maintain their discipline are the ones who build durable wealth through multiple cycles rather than paper fortunes that evaporate when conditions change. That is what I have learned from living through 4 decades of technology booms and busts. That is what I hope you take away from this discussion. Not fear, but wisdom. Not paralysis, but preparation. Not pessimism about the future, but realism about how markets work and how to navigate them successfully over the long term. The future of technology is bright. The opportunities are enormous. But the path to capturing those opportunities runs through cycles that will test your discipline and your resolve. Be ready for that test when it comes.